This January 2024, the Federal Reserve really changed the game on us, putting a stop to raising interest rates, but keeping us in suspense without any clear signs of lowering them. Yeah, you heard that right. When everyone was betting on what's next, the Fed decided to keep us guessing. Now, why is this a big deal? Think about it. Your loans, your savings, even your next big investment move, all hanging in the balance on what feels like a financial cliffhanger. So what's the real story behind the Fed's poker face, and more importantly, what does it mean for you and me? I dug deep into the latest updates, piecing together the puzzle of economic signals, market reactions, and the Fed's strategic play. This isn't just another news recap, it's the insight you need to navigate the waves of 2024's financial seas. And why should you stick around? Trust me, understanding this could mean the difference between making a smart move or getting caught off guard. So let's dive into this together and figure out how to play the game by the new rules the Fed's setting. All right, let's keep the momentum going and talk about the recent Federal Reserve's 2024 decision that came up just this end of January. What a way to end the month, right? This is such a pivotal moment that's reshaping the economic landscape as we know it. So the Federal Reserve, in a move that's got everyone from Wall Street to Main Street talking.
This really matters for people because if you're trying to buy a house, this is going to increase what you have to pay monthly on a mortgage, right?
Has signaled a significant shift in its interest rate policy. On Wednesday, January 31, the Fed sent out a clear message. They're done with the rate hikes for now. But here's where it gets really interesting, guys. They're not jumping into rate cuts either. And you know this decision marks a departure from their previous stance, where they seemed committed to raising rates until inflation was reined in and on track towards the Fed's 2% goal. So what's behind this change? It's a mix of caution and strategy. The Fed's statement, which concluded their two-day meeting, showed a nuanced approach. They're acknowledging that inflation, while still above their target, needs a more measured response. The statement indicated that the Fed won't consider reducing the target range until they're confident that inflation is sustainably moving towards that 2% mark. Now Fed Chair Jerome Powell, during his news conference, emphasized the need for more data to confirm that these trends are continuing. He expressed doubt about a rate cut in March, stating, "I don't think it's likely that the committee will reach a level of confidence by the March meeting." This cautious stance reflects a broader theme in the Fed's approach. This just means that they're not just looking for better data, but a continuation of the positive trends they've been seeing. He's not just looking for a few good numbers here and there. He wants a consistent pattern of positive data before making a move. His cautious approach is about being absolutely sure before changing anything. The market's initial reaction to this announcement was relatively calm, but things took a turn following Powell's comments. Doubts about a March rate cut led to a notable shift in sentiment. The Dow Jones Industrial Average, for instance, dropped over 300 points and Treasury yields saw a significant plunge. This reaction underscores the weight of the Fed's decisions on market dynamics. Futures pricing also reacted to this uncertainty. The market, which had been assigning a probability to the Fed's next moves, shifted its expectations. According to calculations by the CME Group, there was about a 64% chance that the Fed would maintain its current stance in its March 19 to 20 meeting. But listen, it's not just about the immediate market reactions. The Fed's decision has broader implications here. By removing language that suggested further rate hikes and not committing to rate cuts, the Fed is signaling a more flexible, data-driven approach. This change is significant because it indicates a departure from the more predictable, set path of monetary policy that we've seen in recent years. The Fed's statement also reflected changes in how they're assessing policy. They've moved away from considering the lagged effects of monetary policy, a recognition that the economic landscape is evolving rapidly. This change suggests that the Fed is adapting its strategy to a more dynamic economic environment where traditional models and expectations may not always hold. Think of the Fed's decision as a big chapter in the ongoing story of our economy. They're being super careful right now because there are hints that the job market isn't growing as fast as before and people's paychecks aren't getting much bigger. Also, the rate at which prices are going up is starting to slow down a bit. So what the Fed is trying to do is kind of like landing an airplane smoothly. That's what they mean by a soft landing for the economy, although they have mentioned that they haven't reached that point anytime yet. Now let's expand on this soft landing concept. Imagine the economy as a plane that the Fed is piloting. Just like a pilot trying to land a plane gently, the Fed's goal is to bring the economy down to a stable level without any jarring movements. They're aiming for a scenario where we avoid both a crash landing like a severe recession and overshooting the runway, or an overheated economy leading to runaway inflation. Achieving this soft landing is a bit of a tightrope walk. On one side, there's the risk of inflation, which means the cost of everything from groceries to gas keeps climbing. On the other side, there's economic growth, which we all want to keep chugging along healthily. The Fed's challenge is to cool down inflation without freezing economic growth. To do this, they use as their control levers. Think of it like adjusting the speed and altitude of the plane. By pausing interest rate hikes, they're essentially not pushing the throttle any further, which could slow down the economy too much. At the same time, by not cutting rates, they're avoiding adding too much fuel that could make inflation soar again. Here's where it gets really interesting. The data the Fed looks at to make these decisions includes stuff like employment numbers, wage growth, and various inflation indicators. For instance, if wages are growing too slowly, it could mean people have less money to spend, which can slow down economic growth. But if wages shoot up too fast, it can lead to higher inflation. It's all about finding that sweet spot. In recent times, we've seen some signs that the economy is responding. Inflation rates have shown signs of easing in the job market, while still strong, isn't overheating. This is good news because it suggests that the economy might be approaching that ideal balance, not too hot, not too cold, just right for a smooth landing. The Fed's policy adjustments also reflect an evolving economic landscape. They're navigating between the risks of inflation and the prospects for growth. This balancing act is crucial because it affects everything from consumer spending to business investment decisions. So the Fed isn't just hitting pause on changing interest rates. They're also tweaking how they handle their massive pile of bonds. Think of it like this. They're trying to keep prices from going crazy, and that's inflation for you, without messing up the economy's growth. It's like walking a tightrope. They're being super careful with any changes to interest rates while still doing their thing with the bonds. They're playing it smart to keep our economy stable and growing. Now, on to something else pretty big. The Fed's also shaking up its rules about how its top dogs and staff can invest their own money. Why? Well, there was a bit of a stir about some iffy stock trades happening when big decisions were being made during the early COVID days. So the Fed's stepping up its game to make sure everything's crystal clear and above board. They're basically saying, hey, we're making sure our people are making choices that are good for everyone's wallet, not just their own. It's all about winning back trust and making sure their decisions are all about keeping the economy on track. These policy changes are not just administrative tweaks. They're about reinforcing the integrity of the Fed and its role in the economy. By requiring more stringent disclosures and possibly even brokerage statements from staff with access to confidential FOMC information, the Fed is sending a message, and that is that they're serious about accountability and transparency. Now let's anticipate the next Federal Open Market Committee meeting happening on March 19 to 20, 2024. This meeting is a big deal for anyone keeping an eye on the economy, investments, or just trying to figure out what's next for their finances. The Fed has been holding rates steady at 5.25% to 5.5%, aiming to keep inflation in check while not putting too much strain on economic growth. But here's where it gets interesting. There's a buzz around whether the Fed will start cutting rates later this year. And everyone is looking forward to this, as the direction the Fed takes can influence everything from the stock market to how much interest you earn on savings or pay on loans. Some experts are leaning towards the possibility of rate cuts by summer, depending on how inflation and other economic indicators play out. This upcoming meeting could give us some clues about the Fed's strategy moving forward. So, what should you be watching for? Keep an eye on the Fed's statements post-meeting. They'll be looking at inflation trends, employment numbers, and overall economic health to decide their next move. This could mean changes to your investment strategy, whether you're into stocks, real estate, or crypto. And for those thinking about buying a home or refinancing, the outcome could impact mortgage rates. So that's it. The Federal Reserve's January 2024 decision is more than just a pause in rate hikes or delay in rate cuts. It's a reflection of a complex, evolving economic landscape and the Fed's strategic response to it. This decision impacts everyone, from investors to everyday consumers, and it's a reminder of the central role the Fed plays in shaping our economic destiny. Do you believe the Fed's strategy will work out? How do you see it playing out in the coming months? Don't hesitate to share your thoughts in the comments, because this is a discussion that's constantly evolving and your insights are a big part of it. And speaking of evolving discussions, you've got to check out more updated videos in my channel. If you found today's discussion on the Fed interesting, make sure to hit that subscribe button because you'll definitely want to check out more. See you in the next video.